The emerging markets have, the PE ratio on emerging markets is only around 8 times, which is almost a 65% discount to the ratio for US stock markets. So, this is something kind of we need to take into account. Yeah. The other thing which people have been looking at in detail is this flattening of the curve. And as you can see from this curve, again, a lot of things are happening. China has obviously been through this whole cycle, and it's kind of like now flattened out for the last few months. The key thing to note is now that on around the 76th day, Wuhan has travel restrictions have opened, and you can see all these people at the Yellow Mountain. So a whole bunch of people are getting out of their houses. And what everybody else thinks is that the curve for the US, Italy, Spain will kind of follow this. It's a little bit above where China was at this point of time, but people are, drawing the line downwards, and they're like, it'll come somewhere here like this. So people are kind of looking beyond what's kind of happening right now, and they think that things will normalize. What people are looking at are not just deaths, but how many deaths are there in addition to the normal. For example, to give you an idea, US has 6,000 deaths a day on a normal, every day. And the coronavirus has increased that by maybe 500 to 1,000. Then the coronavirus numbers are about 1,500 to 1,900 that are being reported. So, but some of them would have happened in any case. So people are looking beyond that. Also, to what kind of how long will the disruption last? Again, like I said, China has shown that in 75 days you can go back to removing the travel restrictions. So people are aware of all these things and using that in their prediction model. Of course, some industries will get impacted, some will benefit, some will be hurt. But ultimately, productive capacity will kind of come back. Also, the news out of China has been very positive. I know that not all of you may believe all the data that is released by China, but now we have the availability of alternate data sets, also big data. And that kind of gives us a lot more comfort in terms of what the data is coming out. I.e., we know, traffic numbers, we know, Starbucks and Apple stores, what they're doing, electricity generation data, and and so on and so forth. So kind of that gives us a little bit more comfort and confidence in some of this. Okay. What other progress that has taken place in terms of the coronavirus is also what have the governments done. The government reaction has been to do whatever it takes, and that has resulted in huge stimulus, both in monetary policy as well as a fiscal policy. The numbers are kind of staggering. U.S. announced $3 trillion of purchase of treasury, agency securities, corporate bonds. ECB another like 750 billion. Bank of England another 1 trillion. The Group of 20 promised 5 trillion. One kind of loses these numbers. The Japanese yen announced another kind of 1 trillion. But if you look at it in terms of as a percent of GDP, now US literally generates about 1.5 to 1.7 trillion dollars a month. So when you look at these numbers in comparison to what the GDP is, you realize that these numbers, which are going to be spent over the next 2-3 months, are a significant portion of GDP. And could really make a huge difference to how the economies operate. There's a very nice graph on the right side, which you can see how the government response has been. Many countries, for example, Japan is saying about 15-20%. It's kind of moved from here. This is an older graph. India is on the other end, where they haven't spent much in terms of the GDP, but what they're doing is they've had very stringent controls in terms of lockdowns and how people can come out. So that's on one side. On the other side, Japan has not had much very stringent controls, but has obviously been spending a lot of money as stimulus there. Singapore just announced today 12% of GDP, and 12% of GDP spent over a couple of months is effectively almost 100% of GDP. So that's what everybody's looking at. So I think one of the things that people are looking at is volatility. When volatility comes down, people think it will finish. And if you look at the extreme graph on the right-hand side, you will see that the last time the volatility was so high was in 2008, 2009, the global financial crisis. At that time, so I'm looking at a 40% kind of a limit. So when it goes above 40%, obviously, people are very concerned. So at 40, so it was over 40% for about 6 months. Now it's been over 40% for just like 1.5 months or so, and almost coming down. I can see some of you raising hands, but unfortunately, I'm not so good with the computer, so I'll probably take them at the end. But you can keep giving the questions nevertheless. So volatility, even if you look at the last week, it's been plus a lot on certain days, it's been minus a lot on certain days. So, and the extreme left, the Excel sheet shows that out of the number of most volatile up or down days ever in the history of the stock exchange, a lot of them occurred in 2020, i.e. this last 2 months. So obviously people are concerned about volatility. Once it comes down, it may already be too late, but that is something which is going to show where the market is headed in terms of stabilization. Or alternatively, when Warren Buffett invests his cash pile, that would be a big positive bullish signal. He's still sitting on $130 billion odd. So that's kind of important too. Okay, so so we kind of have an idea that, over the next couple of months, it will finish, but, there may be a second round when people get infected again. But I think people have learned from their experience and what's happening in China, South Korea, etc. And I think it will definitely be more muted compared to those places. So what's the impact going to be in terms of, consumers, countries, economies, and so on and so forth? Obviously, the consumers are, folks spending a lot of money on essentials. Rice prices are at 6-7 year highs. It's quite interesting. You can see like which are the top items which are being demanded right now. So, you can take a guess, but I'll tell you, like hand gloves, disposable gloves, and bread machines the demand is almost 7 times last year, March over March. On the other hand, things like suitcases and cameras, the demand for those is down 80%, right? So, alcohol consumption is up 45% in San Francisco, the Bay Area. People are buying a lot of wine, mainly wine actually, and vodka. Vodka is up 75%. So, those are kind of some interesting pieces of data. Interestingly, in China, divorces are up. Applications for divorces are kind of significantly up in China. So we have all these kind of pieces of data from all over the world. 40% of tenants in US, in New York, may not be able to pay their rent for April. Zoom users, as you're all on Zoom. Zoom users are up 20 times since December. So, a lot of change in our behavior. The social distancing will change how we live and work in future. A lot of us are, at least for Kristal.AI, we are all working. A lot of us are working from home around, 3 different locations with Zoom on the whole day, and our productivity. I hope it hasn't gone down. I think it hasn't gone down much, but obviously we will improve. Countries are also responding differently. There's a trend towards nationalistic policies. You can see how Trump has been speaking. Global supply linkages. People are concerned about if they have to rely on other countries for their medical supplies. And of course, travel restrictions, they will go away, but they will exist in some form or the other. In terms of industries, obviously there'll be a short-term impact. For example, airlines, leisure, hospitality, this is almost 10% of the global economy. So this is going to definitely take a hit for some period of time. On a longer term basis, some companies may not survive, especially the ones with stretched balance sheets. It is definitely going to be a 3 to 6 month period, even at the optimistic level, where companies will have to survive and pay their fixed costs, and some companies may not be able to do that. Also, the implications of government support are going to be quite different for different companies. While Boeing may survive, if the government has given it a few $1 billion, how will the government get involved in its future operations? There's again a couple of graphs. The one in the center is quite interesting in terms of which industries are likely to do better post the coronavirus and which will do worse. So you can, it's kind of guessable. It seems quite logical and practical, but it's interesting to have a look at that nevertheless. Immediately in the short run, you can obviously guess that Amazon and companies, doing online retail are the ones who are hiring big time. Some good data points to see there. It's interesting that, of course, the other thing which is there, most of these industries you'll see will have to digitally transform themselves if they're going to live or survive well in the post-coronavirus era. So that's a nice, interesting joke. Which one led to your digital transformation? Okay, the economy. Again, we know that some aspects of the capacity are going to be lost forever. Shutdowns. Tesla factory closed in the U.S. All the cruise liners are standing idle. A lot of airlines are standing idles. The services, obviously, that capacity is lost forever. So the economy will definitely take a hit on that. So we know that. But in China, for example, 90% seems to have be back online, and that may happen quite fast in the rest of the world too. But some will be lost forever. Also, people haven't noticed this, but the whole reaction by the governments and by many of the states to the epidemic have led to a significant transfer of wealth, whether it's through fiscal stimulus or monetary stimulus. It's gone from the richer people to the needy people, from landlords to tenants. They're giving rent rebates, from borrowers to savers, mortgage relief, reduced interest costs, etc., etc. So there's a significant transfer of wealth from people who save to generally people who spend. And this also has implications for the future. And also as investors, as you and the people listening to the webinar and ourselves, we have to see, how do we react to this in terms of where we invest, how we invest, etc. Timing is something which I get asked about quite a lot. That's something which is very difficult to do, but it reinforces the general methodology that we adopt for investing, which is an allocation methodology across asset classes. The markets look nasty. Some people think they're still nasty, that this is a bear rally and the next bottom will be further down. But they can turn quickly, as we've seen. The markets were in a bear market. They were 35% down, but in many cases, they've already rebounded 20%, and that would categorize them as a bull market. So it's been one of the quickest switches from one to the other. But we need the interest rate world has become a very low interest rate world. It was already negative in Europe, and the US seems quite close to it, with even 10-year, etc. 20-year being below 1%. So the virus should pass, but of course the future impact is something that we need to be mindful of going ahead. So that kind of takes me to the end of the brief about coronavirus and how we think it might impact the world going ahead. What should we do now that we have some idea of it? Not all of you may agree with my analysis. The data is out there, but of course people look at the same data in many different ways. You may feel that it's the data points to a very bearish outcome. I'm tend to be a little bit more bullish, and even within our company, we have different viewpoints. But the usual questions that we get is it a good time to invest? Have we reached the bottom? And if it is, how do I invest? Where do I invest? All those kind of things. Interestingly, some of the brokers, online brokers, even in Hong Kong and Singapore, are seeing 4 to 5 times the normal volume in terms of client flows and so on and so forth. I do have a slide at the end about how Kristal is faring in this, and it's quite a positive slide. So if I have time, I'll show it. But what I would caution is that it's, when you say is it a good time to invest, I would caution against trying to time the market. Is it a good time? Yes, it is a good time because it was better than like a few months ago. The same stock is available much cheaper. Yes, some of them will be disrupted, etc., and uncertainty is there. But in general, it's a good time to buy. IG is yielding higher than what it was yielding 2-3 months ago. So is high yield. Yes, maybe default rates may have gone up, but in general, if you ask me, it's a better time to invest than it was there before. Will tomorrow be a better time because market will go down further? No one can say for certainty with certainty, but it's difficult to time the market, and that's why we have an allocation approach, which I'm going to cover over the next few slides. And this is the typical traditional Warren Buffett statement. You don't need to be really smart or have high IQ to invest. What you need is to have the right temperament to control your urges, not to panic. And that's brings me to the AI concept, right? Panic affects us personally, and because it affects us personally, it kind of affects us in our behavior, investing behavior too. And AI and the investing philosophy that we follow kind of focuses on the process. It's rational, requires the same effort to be put in every time you invest. Implement a strong investment discipline because of usage of computers, because apply the right risk management. So AI can help avoid some of these tricks that Warren Buffett is referring to, which is to control the urges that get people into trouble. If the market is down, you panic. If the market is up, you feel very bullish and you keep, you go all in and you leverage yourself, which is kind of what was happening in January and February this year. So, behavioral finance is very, very important in investment behavior and for long-term returns in the market. And behavioral finance looks at the influence of psychology. So, people are very instinctive. If you're happy, you invest more. You take leverage. If you're unhappy, you don't do anything. Social influence, i.e., who you met, when did you meet the person? I met somebody in the morning, then it said something about, let's say, the cruise industry, so I go and sell my cruise shares. These kind of things are very prevalent in normal day-to-day behavior. You get a stock tip or a gut feeling, and then you kind of buy it on instinct. So these things are there's a lot of research and Nobel Prizes have been won in this topic. But what we say is focus on the process. And if you see this quantitative analysis of investor behavior, people lose money and don't get the same performance as the index because of expenses, but also to a large extent because of their own investor behavior. How does the process help? Having a good investment process help this? The investor behavior and improving your investments. Firstly, you don't try to time the market. It doesn't immunize you from market movement. So, for example, when the market fell in March and it fell across all asset classes, gold was down and treasuries were down at the same time that equity and high yield bonds were down. Yes, it will not immunize you, i.e., it will not protect you, as in you will not have any losses. You will have losses. It doesn't help you to time the market, but it avoids a situation of panic selling, buying high, selling low, because you are comfortable in the sense that you've made a proper allocation. You've prepared for it in advance. The damage is minimized, so it's a recoverable damage. And then when the market recovers and the economy recovers, you're there to catch it. Instead of a situation where you've bought something on instinct, you haven't had any plan to do in case the market falls off, and once the market falls off, you're in a panic situation and you sell everything, and then you are not there to catch the market when it recovers. So the process helps in this case, and that's what we kind of focus on always. Prepare and plan for losses and profits both, right? And how do we best use the process? By defining the risk, by having a risk tolerance predefined. Different people have different risk tolerances. So somebody who is, could be very risk averse, and even a 5% loss, he would consider, he would be sleepless about it. And somebody could, who likes to go to the horse races could, easily withstand a 10-20% movement without a problem. So you have to define your risk tolerance yourself. So if your investments are causing you to lose sleep, it's probably set too high. And remember, everybody likes to make money. So, you want to make 10%. But remember that if you were to lose 10%, the unhappiness caused by your loss of 10% is almost 2.5 times the happiness caused by your winning 10%, right? And this has been proven by behavioral economists many times. So it's a multiple. The unhappiness caused by a loss is a multiple of happiness caused by the same amount. So set your risk tolerance very accurately. Have your return expectations should be in line with the market. If stock markets are going 7 to 10%, to have a 20% return tolerance without return expectation, without the appropriate risk tolerance, doesn't make sense. You need to have some cash, need to have a time horizon in mind. If you're going to retire in 5 years, you need a higher degree of cash, fixed income in your portfolio. Look at multiple asset classes to diversify your investments, and look at costs very carefully. Over a long period of time, costs can really make a difference in your budget. But also remember that this is a life cycle of a typical person. When they start as a student, they're kind of borrowing money, student loans, credit card loans, and then they're kind of saving for most of their working life, and then again drawing down their savings at retirement. So most of the people who are our clients are in the net saving mode. So if you're going to sell and go to cash, then you're going to be looking to invest again sooner or later. So realize that it is better for you to stay invested rather than go into cash and then again go back trying to buy high. Same sell low and buy high approach. So the better approach would be to become more conservative. You change your allocation to conservative when you are a little bit fearful, and then reallocate to aggressive when you're more comfortable with the market. So you don't get out of the market. So you're always in the market, except that you just change your allocation a little bit. Rebalance periodically. Once you rebalance, you will automatically reduce some of your winning positions and take profits there, and also liquidate some of your losing ones. So this is the kind of a good process to follow. There are other examples of behavioral finance. How people behave. Like they only look at they don't look at the portfolio. They look at individual stocks. So it's very important to look at the portfolio as a whole. A home bias. People just tend to invest in familiar securities, which would mean that people in Hong Kong would be investing primarily in Hong Kong securities, even though there is not really that much choice and flexibility available if you were purely restricting yourself to Hong Kong. So you need to look at US, UK markets, and so on and so forth. So this is the kind of the conceptual view of the algorithm that we use. So what it does is, so what it does is it kind of looks at your investment objectives, and if you kind of sign up on our algorithm, you'll go through this process because it's all done automatically by the mobile app, etc. It kind of gathers information about your objectives, your risk profile, your preferences, and then obviously combines it with the historical market data, and then kind of throws out an algorithm results for you. So, we obviously focus on risk. As I pointed out, it's very important that you get a good night's sleep, especially in light of the virus, and that's what we try to ensure. We try to ensure that we're not trying to maximize return for you, but minimize the volatility for that level of return that you're looking for through diversification. The theory is quite old. Financial market theory hasn't really changed over the last 50, 60 years. It's a main market. It's a modern portfolio theory model. We use Black and Litterman to add expert IC views on it. The IC means our investment committee, our in-house investment committee, who is all basically traders with more than 15 to 20 years of experience each. And that kind of throws out the portfolio. So what I've done is I've just taken an example of one person who'd run the algo just today. So it wasn't run by me, but one of our clients. And then what kind of results it threw up. So you can see that there is a balance between treasuries. Just see here. Yeah, you can see that there is a some treasuries here, some bond ETFs, but also aerospace, which interestingly the algorithm has picked up. and healthcare. So healthcare, obviously, everybody understands, but aerospace, just because it's very beaten down. So you pick that because at a certain price, everything starts to make sense value-wise. So the investors 5 to 10 year time horizon, equities, ETFs, and this is the kind of a typical profile of a client, and this is what it has led to in terms of the results from the algorithm. You can try it yourself. So that kind of brings me to the end of my presentation. So I'm going to take some questions. I think we already have some questions there. So can I know what the questions are? Or how do I look at this? Okay. Yeah, I got a question on what my view on inflation is. So obviously, all the fiscal and monetary stimulus is definitely going to have put some pressure on inflation in the near future, which is why gold is kind of become important as core holding, maybe like between 5 to 10% of core holding in gold and other inflation linked assets. There's obviously inflation linked treasuries. Property provides inflation hedge in some cases. So these are important things to take into mind. Now, will inflation go up immediately? It's unlikely, because obviously there's been a big shock to demand also, as you can see in oil prices. So there's been a shock to demand, and inflation goes up when demand exceeds supply, and productive capacity there's a significant amount of productive capacity available. So supply, there's no issue on supplies. So maybe over a longer term, there may be some problems with inflation, but immediately I don't think so. But nevertheless, we still advise some allocation to inflation commodities such as gold. Yeah, another question about Kristal recommending ETF related to healthcare. In this one, if you look at what's happening, there's a huge amount of medical progress being made in terms of vaccines and diagnosis, diagnostic kits, etc. And this is going to, till such time as we are able to diagnose it efficiently and immediately, until such time as we have a vaccine for it, we'll continue to search for it. And the whole virus has put a kind of panic in the minds of people. So they're definitely going to be much more careful about healthcare related issues going ahead also. Which is why I think healthcare is one of those areas which is going to be relatively conservative, well protected kind of a castle in terms of the industry. And you've seen that the healthcare companies haven't really come down a lot. The algorithm is picking it up on its own, actually. So it's not as if we are, as an investment committee, is putting something there saying you have to book healthcare. It's interesting that it's looking at the data, it's looking at the volatility, and it's automatically suggesting healthcare as part of the portfolios for our companies. Okay, how many inputs are there in the algorithm? How complicated is the algorithm itself? It's a lot of inputs. Let me just go back to the now investment objectives is relatively simple. You can put whether it's growth or income or time horizon and so on and so forth. The risk profile definitely has multiple inputs. You could be categorized as an investor in many different risk profile buckets, from retail to highly sophisticated, and depending upon which risk profile you fall under, you will see a different set of investment opportunities available to you. Your preferences would all be different. So what I'd like to point out is that each of our customer actually gets a different so we are different from other people in the sense that each one gets a customized portfolio that is suitable specifically for that person. We don't have a cookie cutter 3-4 portfolios and we put you into one of those. So you could have different preferences, you could have different risk profile, different objectives, and 1,000 different investors would get 1,000 different portfolios. And yes, of course, it would change over time, because markets change, volatility change, correlations change. So there's all this part about the historical market data, and depending on the market data, it is taking literally tens of thousands of data points into the analysis, and that's all these inputs go together to give you the results that I showed you before. And the different runs of algo will give different results. Typically, what we say is that don't run an algo every 3 months. Give it about 4 or 5 months, and then follow the algo results. So if it recommends some changes in your strategy, then do that. But don't run it every day and try to change your portfolio every day, because that's it doesn't optimize and just incurs additional cost. Uh, Another question is on the US dollar itself, whether it will weaken or strengthen based on all the stimulus that's doing. Obviously, we've seen in the recent past the dollar being quite strong, primarily due to it being a kind of a reserve currency and as a flight to safety currency. I don't think it's going to be like that of going. If I look long term, in the short term, yes. Short term, US still determines capital flows globally, but we've seen from the reaction, and we've seen from what's happened in Asia in terms of the control of the virus versus what's happened in the US and Europe. So I'm very positive on Asia, actually. Personally speaking, I would be much more invested in China and India than I would be in the US and Europe. But this will take a few years to play out. It's not going to be something that is immediate. In the short term, the US does have the natural resources, and the fiscal stimulus will definitely lead to quick growth in the US and a stronger dollar near term. But long term, I'm more bullish on Asia, we think. Another question, will QE help stimulating the economy? Well, right now, it's not just QE. It's just QE and fiscal stimulus both. There is money being put directly in the hands of the consumer. In Hong Kong, they're giving 10,000 Hong Kong dollars to each person. They're giving, I think $80,000 to each shop. And now they're giving, about another $40,000-$50,000 to each bar, to massage shop. So they've announced 130 billion Hong Kong dollars today. Carrie Lam announced today. So the money is going directly to the end user, which is different from quantitative easing, where it goes into the system. And the amounts are so huge that they will definitely perk up demand for consumer essentials in the short run. Like I said, if you're spending 5 to 10% of the GDP in a few months, that's basically you're spending 100% of the GDP in those 2-3 months. And that will definitely have some impact on the cheaper consumer goods, i.e. the essentials and the basic consumer goods. Maybe not luxury items, but definitely at the basic level. Okay, is our algo model applicable to the market? Well, we look at the algo looks at the global markets. So it looks at instruments in the US, UK, China. It looks at the most efficient investment for each of those markets. So it's already global. So changing, we don't really need to add anything else. We do look at all the investments that it looks at from time to time, and we keep adding to it and keep subtracting to it. If there's a better one available, then we move to a better one. We try not to have multiple ones in the same cluster, i.e., we try to remove, we try to pick the best investment in each cluster. So I think, obviously we are improving it on a constant basis, but currently it satisfies most of our clients and our requirements. And so you must remember that we've been working on it for 4 years now. It's gone through various generation 1, 2, 3, 4, etc. So we are kind of between 3 and 4 now. So it has been fine-tuned many times already. So we hope. Just to add, we actually going to launch a algorithm-based Kristal, which will have no human inputs. We are in the final steps to be launching that, and that will effectively, the algorithm will determine where the investments go. So we will not mess with it at all. This is the level of confidence we have in the algorithm now, to let it make the investment decisions, and the investment committee may put some money also, or our own money there. So that's for how much we believe in it. Somebody's asking me for more details of the algorithm. Actually, yeah, well, I think I'm going to put a couple of YouTube videos on our YouTube channel. So please follow, which will explain the algorithm in more detail. We're kind of running out of time. We have about 5 minutes, so I'd like to kind of take more general questions. But definitely, please do follow our YouTube channel, and then if we'll try to put some YouTube videos on algos, etc. on that. Okay. So yeah, that's kind of like at the end. Is there anybody else? Any last questions? I could take probably one more, I think. But let me see. Details. I've covered all the questions. Yeah, I saw. I'm just to come back to there was one thing. How has coronavirus impacted Kristal? Let me get to that one. I never got to that one. Yeah. So since I have time, definitely we've seen a big impact, a very positive impact. We see more online activities, growth in page views, signups, etc. Obviously because I think people are spending more time at home, so they have and they're concerned about their financial security. I think so. They're definitely looking at apps such as ours. So logging on, signing up, etc., etc. So we've seen a growth in the last 2 months. In terms of client experience, we haven't seen too many people closing their accounts or withdrawing the money. There have been a few, but not significant. I think the retail investors are handling their volatility quite well. Also, you must remember that most of our clients tend to be on the younger side, so they have many years of saving left ahead of them. So I don't think I think they're learning from this experience in terms of volatility. So we've seen a lot more signups rather than any significant pickup in closures. And it has kind of helped our model in terms of communication, because we were always built for digital communication in terms of emails, WhatsApp, in-app notifications, which some of those big traditional banks were not. So as a result, our communication with our customers has been very strong, and also people have had the ability to talk to human relationship managers if they wanted to. We've got a lot more media coverage, because there haven't been that many positive stories, but we've definitely been a positive story, and I can show you my little photos in all the local Hong Kong papers. Just doing some self promotion there. So this is only in the last 2 months. So we've been featured quite widely in many of the local Hong Kong publications. There was one last question. What are we doing for the mass affluent? Well, we're a fintech, and we're a digital wealth manager. So most of our exercise would be digital. In terms of communication is digital media. We have a YouTube channel. Please follow that. Where we're going to put more and more stuff relating to teaching people how to invest, and the use of AI, use of how existing advisory is different from what we offer, and how the algorithm differs. So follow us on YouTube. We'll be doing much more on that. We're going to be having a webinar almost on a very regular periodic basis, because that's one of our customer outreach. So that's another thing that we'll be doing. And any feedback welcome. We'll try and implement it. This is the mass affluent is a core target market. A couple of questions on last one. I think commodities. I think as I mentioned, the implosion in demand is definitely not going to be great for commodities. So they've already been beaten down, and you see people are talking about crude oil down to 20 and 10, and I even heard some people saying negative crude oil because of storage costs. But I don't think it's going to be that dire. But definitely, the implosion in demand and productive capacity for the few months will lead to some stockpiling of commodities and some downward pressure there. Okay, I think on that note, I'm going to call it. Is the last question? It's about ETFs. I think we're going to try and cover some of these in our YouTube videos, like I said. So thanks for joining us. Please do join us for the next time. sign up and look at our algorithm and our app and give us feedback. Thank you.